Hello, everyone. Good morning, good afternoon, good evening, according to the time where you are. I hope you're all doing well. Our last webinar of the year. As you know, I like to start with a brief introduction of the ICCP before I hand things over to our presenter, Mark. So if you haven't joined us before, welcome. I hope you enjoy it and come back again. And to those of you who have been before, welcome. Glad to see you back. All right, and with no further ado, I will go ahead and begin with an introduction of the ICCP. Okay, the ICCP is a professional members organization that recognizes those with the skills, qualifications, and expertise in the professional management of construction claims. So we have three main objectives, which are to establish international professional standards, to give recognition to those who have gained the knowledge, skills, and experience in the management of claims, and to help and educate those who wish to gain that experience in the professional management of claims. Now, why is there a need for the ICCP when there are so many other professional organizations in the construction field? Well, quite simply, construction claims have become a key part of the international construction industry, and claims professionals come from many backgrounds, from quantity surveying, engineering, project management, legal, et cetera, et cetera. They all end up in claims, and until the ICCP, there has been no institute specifically recognizing those with the specialist knowledge, experience, and skills it takes to manage, prepare, and respond to claims in the highest professional manner. Okay, so I will quickly introduce our steering committee. We have an executive officer, Andy Hewitt. Paul Gibbons is our current president. We have three elected fellows, including today's presenter, Mark Watson, and Nina is our general manager. She is currently on maternity leave, and I'm taking her place for the time being. Okay, and in terms of membership, we have three levels of regular individual membership. We also have two levels of membership for those just beginning their careers, student members and graduate members. Each of those five levels has its own set of criteria to achieve that level of membership. We also have corporate membership for companies that specialize in claims or companies with departments that specialize in claims. And what's in it for the members? What do members get out of joining the ICCP? Well, we have a private member area of our website, which has a knowledge bank of articles, white papers, research, et cetera, on claims topics. We have an education section, which has a collection of resources of further education and training. We also have a training section that has upcoming CPD opportunities around the world. And the education and training, I will point out, are not related to the ICCP. It's just collected knowledge to save our members from having to do the research to find universities or CPD opportunities. We also have a book shop, which again doesn't sell books, but it has reviews of the latest industry releases on claims and contracts topics. We have a growing library of templates, which help our members save time and also ensure that their claims are completed to the highest levels of professional standards. We have regular CPD opportunities, such as this one. So this webinar is open to the public, but a certificate for the CPD time is a benefit of membership. We also have the ICCP Academy. So today, directly following this public webinar, there will be an ICCP Academy, which will delve into this same topic just a little bit deeper. Okay, we also have discounts with two publishers, as well as from our training partner Claims Class. We have a monthly newsletter to keep our members up to date on what's going on in the industry. We have industry exposure in the form of a public listing of our members. Members also receive a certificate of membership and logos. And we have a private LinkedIn group where our members can discuss their contracts and claims questions in a confidential manner. Finally, we have the optional benefit of our register of claims practitioners. So this is mostly popular with our members who are consultants, and it's a good way for them to increase their online profile. Okay, so I realized that was a very quick whirlwind tour. So if you'd like to know more, you can visit our website, instituteccp.com. You can email me, jennifer.smith@instituteccp.com. Or if you requested further information about the ICCP when you registered for today's session, don't worry, I will be getting in touch with you with further information. And with that, I will hand over to Mark. So we can spend as much time as possible on today's topic that you came here to see. All right. Everybody, this is Mark Watson, our steering committee member.
Thank you, Jennifer. I'm not going to put on my camera, if you don't mind. I'll just put up the slides. I want to advise everybody that in South Africa we have a concept called load shedding, whereby they decide to cut our electricity off in rolling blackouts. We are currently in a load shedding phase. We started about an hour ago, and it's about an hour left. But we have got a generator which is working at our offices. So therefore, I'll prefer to keep my camera off. But I'll just put on quickly and just say hello. So good everybody. I'll go off again. So today, let me just put up my slides. So today's topic was brought about when one of our members sought some information around this topic, and it was passed on to me, and I assisted this member. And then we decided, so Jen asked me if I could get to do some presentations at our webinar series and the academy series. And I said, yes, of course I'll do it. And judging by the number of participants today, it seems to be a topic that is fairly close to a number of people's hearts and a number of issues. Before I get into the gist of the presentation, I want just to discuss the Octadeus disputes the report. And every year, Octadeus is a consulting company in the UK. They put together an annual report. They look at all the global disputes in US, Europe, Middle East, and the actual UK market. And they look at the top causes of the actual disputes. One of the top causes of disputes is that the cost data doesn't seem to be forthcoming. So contractors tend to hide the actual cost data, and then in conjunction with that is an issue about the program review, and then the last one, top three, is about the parties to the contract not fully understanding the actual contract. And I think that is very relevant in today's discussion, because I've been in a number of matters as advisor or as expert witness where this matter tends to come around, and disputes arise because in terms of fixing or revision of rates, when it's appropriate to do that, and what are the substantive requirements around that. I've also found a lot of matters that these requests for varied rates or new rates, the rebuttals in terms of that, it tends to focus on the preposition that yes, the quantities may vary. However, there were no major changes in the deployment of workmen, equipment, or materials, and it can become very frustrating. And on the one hand, we find the contractor have a huge claim in terms of these issues, and on the other side, the engineer has got a different view. And as with any claim dispute, there's always on the contractor side, it's the best case scenario, and on the engineer side, it's the worst case scenario. Now, what I must also state is that it depends on the type of or the form of contract that you use. So today's presentation would primarily speak to the FIDIC Red Book in standard form, looking both at the 1999 and the 2017 editions of the FIDIC standard form Red Book. On the NEC, there's a different approach, but we won't get into that, the time constraints. And then you have JCT, which looks at it differently. In South Africa, we have what we call the JBCC, which aligns very closely to the JCT. And then there, of course, we have the GCC, which is predominantly used on our actual roads projects in South Africa. And then around the world, you find all sorts of contracts that portray to be FIDIC, but it's actually been bastardized to such an extent that doesn't reflect the provisions of FIDIC or the intention of FIDIC. So, in terms of the FIDIC Red Book, there are basically, I believe, there are 4 key principles which one needs to consider. And the first principle is that you need to refer to the appropriate contract clauses when you want to establish the method of measurement. Okay? Now, what I find often under the FIDIC clauses, you've got your subclause 12.2, but then under the specifications, in particular conditions, there's a number of requirements. So I would not be able to talk to all of those requirements. That is why, for the purpose of this presentation, I'm only sticking to the standard form of FIDIC. And the assumption is that there's been no amendments to the contract clauses and under the particular conditions. And what's in the general conditions is how it stands. And that's how we're going to advance the presentation and the case studies in terms of that. So what's also very important to understand is that every construction house company they have, or engineering house, they have their own, referred to as local practice. However, under the law of contract, there is a principle called the parole evidence rule. What it means is that your contract is contained within those documents that is set out that forms the contract. So from the front cover to the back cover, from your letter of acceptance, your contract dated, your particular editions, that forms your contract. Local practice, or whether it's an in-house local practice or engineering local practice or contracted local practice, has got no sway under the contract, and it's got, in my opinion, it's got no place under the actual contract. And often you find that your commercial contracts team will say, yes, but this is how we measure it, and this is what we are going to put forward. And what we often find is that the measurement is completely, or the method of measurement is completely contradictory to that which is stated in the actual contract. In South Africa, for example, we utilize what we call the COLTO specification. And the COLTO specification we use often on various road projects. And on every road project, whether it's under FIDIC or GCC or NEC, the COLTO schedule will always have, or method of measurement will always be form part of the actual contract. In that instance, you then got to look at the priority of actual documents to see which takes preference. And there's a number of times where claims will be made under the COLTO specification, whereas it has no place there, and in terms of priority of documentation, the particular pieces take precedence. So as I was saying, local practice has got on the contract, and normally under your standard form the requirement is that your method of measurement is performed in accordance with the bill of quantities and any other applicable schedules. As I was talking about the alter schedule, but in this, for the purposes of this presentation, we will not introduce any applicable schedule, no culture, no other form of method of measurement. And then also we're going to consider is that the net actual quality of each item of the permanent works is to be measured. Then there's also a variation procedure requirement. Under the variation procedure, the contractor can put forward a proposal for evaluating the variation and providing a cost in terms of that, or it can be under instruction by the engineer, where the engineer will instruct and say, this is how you measure, and then we tend to end up in some sort of dispute after that. And then very importantly, it's also subclause 20.1. Now, what subclause 20.1 means is that when you do an evaluation or you try to establish the additional payment in terms of cost, it is important that you need to, the contractor substantiates the whole of the claim. And if the claim cannot be substantiated, then payment can only be made against that part of the claim that can be substantiated. And what this does is, and what I find often in practice is that there's a lot of continued reliance on global type claims or earned value. Now, earned value is a principle we're not going to discuss here, but as a method is often adopted by project control professionals, found its way into various claims practices. But if you look at the wording of the contract in standard form, you will find that earned value calculation probably goes against that which is contained within the actual contract. So if you look at this is a typical IPC, which I've used taken from a different project, what you'll find that is there will always be a bill of quantity item, there will be a payment reference number, there will be a description of the actual works, there will be a unit and rate, which is in the contract, and there will be a total to date. So, for example, if it's 100 cubic meters of specific product, you measure it or evaluate it during the measurement period, and that will form part of your actual IPC. And as the work progresses on a month, but normally on the FIDIC, on most contracts, you will find that the 25th of every month will be the cutoff date for the actual measurement purposes. And then you track it on a month-by-month basis or week-by-week basis, depending on what your company's requirements are. And you can then establish exactly what's in the contract, is any changes, what you've done to date, and what is the actual remaining works, and your costs will be attached to that. That's a very simple and straightforward process. The third principle is that the evaluation must use the data and information contained in the documents that form the contract. Then it can be based on any local practice. It can be based on any practice that's been instituted or initiated by the contractor and or engineer. It's got to be based on that which is contained within the actual contract. And then, so there's always, if you look at the under FIDIC, there will be a provision for talks about similar work. If there's no rate in the actual bill of quantities or contract, and new works gets done on the variation, it talks about attaching a rate or a price specified for similar work. This I find it's become very problematic, because what is similar work? There is a description of similar work in the actual contract, but that is also very subjective. Then there are various calculation methods or consideration that's going to be done, taken into consideration. And the first is that a new rate would apply under FIDIC when the measured quantity changes more than 10% of the items expressed in the bill of quantity. And then, but by itself, it will not suffice. It's also got to look at the change in quantity, multiplied by the expressed rate in the item bill of quantity exceeds 0.01% of the accepted contract amount. So what is the accepted contract amount? The accepted contract amount is the amount that is set out in the letter of acceptance. That is the accepted contract amount. And then we'll look at, also consider the cost per unit. So that change in quantity, the change in the rate must also have an impact of, must change the cost per unit by more than 1%. And this is where I believe most of the time the wheels fall off in terms of these types of calculations, because the cost per unit quantity is a calculation that's often neglected or ignored. And on that basis, a number of times where I've been involved in assessing claims, I have rejected the claim on the basis that it's not properly substantiated, or it is actually a global claim in nature. And then we end up in all sorts of arguments and disputes in terms of this matter. Okay. What's also important is that where you have a quantity change, a contract amount change, and a cost per unit change, it's also important that those items that sit within those three boxes should not be specified as a fixed rate item in the contract. Okay. And then, like as I said, works in fact under variations and adjustments would be treated differently. We are not going to go into detail in terms of subclause 13 for the purpose of this presentation, because we want to stick to subclause 12. We will be probably in the new year looking at matters of variations. We have not had a presentation in this year on that topic yet. And also, when there is no rate or price specified in a contract with a specific item, talks about you must relate it back to work of similar character, or work that's executed under similar conditions. That is very, very subjective, and it's always open to debate. And the reason being is that you will find that clause normally turns on interpretation. And what tends to happen there is that we tend to involve the legal teams in terms of that in order to argue the actual points. Now, I did some training about 2 weeks back with a client of mine, and I said that we used the concept of 1 + 1 = 2. So a quantity surveyor, an engineer, a construction professional, excluding planners, they understand the concept of 1 + 1 = 2. Construction programs and planners are a different breed. Now, one of them, we understand the concept that 1 + 1 may equal to 5. And the reason being is that if you impact your program, you don't do your program correctly, the answer you get there would not be equal to 2. And so therefore, from when we look at the terminology, similar character or similar conditions, if you ask a lawyer, you'll have a meaning, one understanding. If you ask a construction professional, quantity surveyor / contract manager, program or project manager, a different meaning. And more often than not, you'll find that the contractor and the engineer attaches 2 different meanings to that. And the reason being is that the meaning you attach to it would then always tries to best serve your interest. With the contractor, you read it to serve your interest, and if you're the engineer, you read it to serve your actual interest. And therefore, that wording, similar character and or similar conditions, is very, very contentious. But we will get to that at a later stage. Then your evaluation cannot take place without numerical data or measurement. And the measurement that we're going to do is under subclause 12. Is to measure performance, and we measure the quantity changes, we measure the accepted contract amount changes, and we measure also cost per unit changes. So if you look at the measured quantity changes, it's a very straightforward approach. You look at what was in the bill of quantity. In this instance, there was 970 cubic meters of initial layer. The quantity to date is 13,417. So we know that there is a huge quantity change in the quantity. That change in quantity exceeds the 10%, therefore it ticks that box. But by itself, it will not suffice to introduce an actual new rate. What we need to do is we need to look at how does this impact or affect or change the accepted contract amount. And to do those calculations, you look at the allowed study of contract amount of 517 million ZAR. The quantity in the bill of quantities is 970 square meters. The measured quantity is 13,417.93. The bill of quantity item is 243.05 ZAR per square meter. The change in the quantity is what's important, is change from 970 to 13,417. So your delta there is 12.447 square meters. To get to your contract, accepted contract value with the changes comes to 3.149 million, and then as a percentage, 3.149 million comes to 0.61%. As a change. So in terms of the second requirement, the change should if it exceeds 0.1, then you are good to go in terms of that. So then it will tick, in this instance, it will then tick 2 boxes, okay? Because your under your standard form is 0.01% of the contract amount. So this is a fairly huge or significant change to the contract amount. So out of those three boxes, you manage to actually tick 2 boxes. The third issue that needs to be considered is that what is the cost per unit changes. Okay, so what it means is that cost, because of the change in quantity and also the change to the accepted contract amount, we also need to look at the cost of unit change. Does this change the cost of unit more than 1%? What I don't see in a lot of claims, I don't see this being set out, this being utilized, and or being put forward by the contractor and or the engineer when I act for the employer. So we need to understand first what is a cost per unit. So a cost per unit is normally used in product-based businesses. Okay? It can be used in service-based industries, and we've introduced it to the construction industries. So what it refers to is it refers to the cost of goods sold or the cost of the actual of the sale. So, for example, in the construction industry, it refers to the cost of executing a bill of quantity item of work. So if I go back to the previous slide, 2 slides back, if you look at that bill of quantity item rate, 243.05 per square meter, that is not the cost of sale. That is your accepted contract amount, that bill of quantity item. So we need to establish and identify what is the cost per unit for the actual bill of quantity item. So what it leads to that is that the lower the cost to execute a bill of quantity item, the more profit the company can expect. And this is often ignored when claims are advanced, and also when contracts are seeking remedies for additional cost. We all know under FIDIC, cost excludes profit, and this is I've set up a table in order to make this easier, and we have, I have submitted the table to Jen. If not, we'll upload it onto our FICCP website, and those members can then access it. So it is. I've hardly seen an actual table that talks to this cost per unit. Okay? And it should be used, but it's generally not used in disruption claims. For example, I'll give you an example. We had I'm on a project where we're going to do a diversion tunnel was actually being built. So pre-COVID, the contract data said that, or the contract data says you should work for 12 hours a day, 6 days a week. Yeah. We had COVID, we had a lockdown, we had no work taking place. They came back after COVID, and because of the restrictions, it said that you could only work 8 hours per actual day. What that means is it's not going to take you longer to complete that work, and the total or the cost per unit of that work is going to increase. And instead of utilizing the cost per unit method calculation, a lot of times the contractors utilize earned value calculations, or they advance their claim on an actual global claim basis. This is very time-consuming to calculate the cost to do the cost per unit calculation, because what you've got to establish is within that analysis period. For example, your period of delay between the 1st of March and the 1st of June, you've got to look at all the activities that's been impacted, and you've got to do a cost per unit calculation against each of that activity, and then you can establish what your variance in the total cost per unit is for the cumulative of those activities. Yeah? But the cost per unit calculation is a very simple calculation. It's the total fixed costs plus your total various costs divided by the total units of actual work. Now, I suspect, and I'm not claiming to be the authority on this, but I suspect that if you look at the Arcadis report and the issues around the transparency of actual data, I've found a number of instances where, because the contractor is very reluctant to provide accurate data in terms of its cost data, is unable to undertake this cost per unit calculation. And that's why one of the reasons why you always find in your programming section of the schedules of your specification that we ask for cost and resource loaded schedules, because once we have a cost and resource loaded schedule, we can very easily, it's a lot easier to calculate the cost per unit. What we often find in industry is that your programmer goes off and your delay analyst goes off, he does his time assessment, and then your quantum analyst goes off and does your cost assessment. But the two seldom meet, besides for the fact that they try to understand where the actual delay period was. So it's very important, and I always urge clients to when you put together a program, don't hang on to that cost data and try and not be transparent with it. The more details in your documentation, the easier it is for you to do cost calculation, and also you are able to substantiate your claim a lot better. And keeping in mind, under FIDIC, in the unaltered version, you've got to substantiate any claim for additional payment. And if you don't substantiate it, you are not entitled to it. So it differs slightly under NEC, but under FIDIC, in the unaltered or unamended version, it's an obligation to substantiate any claim for additional costs, whether it's under variation or whether it's under any other clause under the actual contract. So the elements of your cost per unit calculation, you've got your fixed costs, so they normally remain the same with time, and they are independent from the item of work performed, and they may include a contribution to head office overheads, site offices, equipment, rental, etc. This for me is very important because especially over the COVID period, I've seen some claims for head office recoveries, overhead recoveries, and the value of that claim for head office overhead recovery is so excessive that if you look at the work that was going to take place in the specific period, it doesn't tie back to that overhead recovery. And what you got to keep in mind also is that normally those overhead recovery costs are sitting in your bill of quantity, either under your bill of your items, your direct work items, or it's sitting under your actual P&G costs. So you got to be very careful when you do those calculations and how you get those calculations, because what we find now, the employer and engineers teams are moving a lot closer to this cost per unit elements and calculation in order to assess exactly the exact nature of the cost. And that is one of the reasons why we find these huge variances between what the contract believes is entitled to and what the engineer or the employee believe that they are actually in for. Variable costs, they may change regularly depending on the quantity of work performed. So, for example, they may include direct labor costs, direct material costs, etc. So, for example, if you are only allowed to work for actual 10 hours, 8 hours a day, what it means is that you can have your direct labor on site a lot longer. Or if it's increasing in the quantities, you may your material cost is going to go up. So those are all variable types of costs. And normally each company has got its own structure of how it determines, establishes fixed costs and variable costs. And then the third element, very important, is you've got to quantify the items of work and performed and link it to a duration of activity. And the reason for that is that a duration, if you come, like an example I got here, if you got 100 units of work completed in 10 days using a 12-hour day, and you use the same units, 100 units of work, and you're going to say 10 days or 8 hours per day, there is a difference in the cost per unit calculation. Okay? It will give a difference. So it's always important that you look at duration and link it to the duration. And the key element of any successful claim is that it's got to be an integration of the contract, the quantum, and the program. Okay? If we don't have that, it becomes very difficult to substantiate and to quantify properly outside of those requirements in the contract. And what we tend to find is that lots of times people will tend to use their local preference or their company preference, or they will look to the SCR protocol or AECI protocol in terms of finding a solution. But more often than not, that type of solution provides takes on the form of an actual global claim. So if you look at this case study data, so your quantity using the same quantities, 170 square meters, bill of quantity rate is 253.05. Your fixed cost per work item is 130.25 per square meter. Variable cost per work item came to 70.75 per square meter. The working hours pre-COVID is 12 hours per day. The task as planned duration is 10 days. That means that your as planned work units per day averages 97 square meters per day. Okay. The working hours post-COVID lockdown is now been reduced to 8 hours per day. So what normally we experience is that the contract will say there's a number of days, because I've reduced my actual work hours, a number of days late, and then he multiplies that by his daily rate, and he says this is what my claim is going to be like. Okay, but we say no, it should not be that, because number one, it doesn't comply with the requirements of FIDIC. Then you've got to substantiate it. So you're going to look at your as-built data in terms of the reduced working hours. So there's 4 hours lost per day. You're reducing from 12 to 8 hours. So 4 hours lost per day for 10 days gives you 40 hours. And you convert that to working days, gives you additional six working days. So your as-built duration would be 10 plus 6 days. Now, and that will be 16 days. What you also find is that what's very important is that the additional cost that you claim for must be directly attributable to that actual event. So, for example, let's for argument's sake say that this as-built duration was actually 20 days. But from a direct calculation, you can see that because we're reducing my work day from 12 to 8 hours, I'm only losing 4 hours a day. 4 times gives me 16 days. Okay, so if the actual as-built duration is 20 days, then that 4 days can be attributable to the delay event that is actually the loss in working hours. Okay, that means that there's something else wrong there, and what tends to happen is that the contractor tends to say, it's taking me 20 days to do this task, and therefore this is attributable to the reduced working hours, and you find that what should have been 16 days became 20 days, and therefore the concept of 1 + 1 is not equal to 2. Okay? So we're very cautious when you assess these type of actual data, that your calculation, though it's a straightforward calculation, it must yield a result that's linked solely to the event that's giving rise to the contractor's claim. Okay? So what we then do is, once we've established that revised working per day, so that means over 16 days, I'll do 16.625 square meters. My fixed cost will increase, and how do I get my fixed cost increase? It's I take my as planned fixed cost divided by 10 and multiply by 6, gives me 208.40, and my variable costs are exactly the same. It is 70.75 divided by 10 times 6, and gives me 113.20. What I then do is I look at my as planned cost data and my accepted contract amount, which is 253.05 times 970 is 245.58. I look at my total fixed cost. Total fixed cost for that 970 units is 126. My total variable cost is 68,627. I use my formula for the cost per unit is my total fixed cost plus my total variable cost divided by my number of units. That gives me a cost per unit of 201 Rand. Okay? So my profit on there is 52.05 because my accepted contract amount is 253.05. And then take off the 201, that means I've got the 52 Rand profit in terms of that. However, if I apply that same concept of calculation into the as-built data to get my as-built cost per unit, my total fixed cost will be 208.40 times 970 by 970 because I'm still doing the same amount of units over a longer period of time. That comes to 202,000. My total variable cost, same principle apply, 109,000, and then my cost per unit now increases to 321.60. Okay? Therefore, the additional cost attributable to reduced working hours is 321.60 minus 201 times 970. I remove the actual profit margin because costs doesn't exclude cost, and that means that my claim should basically be 116,982 Rand for that specific matter, which is a reduction of working hours and taking me longer to complete the actual base units. This does not, and I mean, even if you have a quantity change, same principle will apply. Now we can see that the change in the cost per unit is more than 1%. Because if it was 1%, it would be 2 Rand. So this change in the cost per unit is more than 1%. Therefore, it discharges the change in quantity is more than 10%. Change in the accepted contract amount is more than 0.01%, and the change in the cost per unit is more than 1%. The final test or discussion in terms of that we'll then have to look at to ensure that those are not fixed cost items in the actual contract. We now look at matters of similar character and conditions. So to understand the meaning of that is that similar means that it's having a resemblance in appearance, character or quantity without being identical. And that in itself, meaning or definition itself, is quite broad, and it's open to a lot of different interpretations. And it's always, from my experience, as the number one cause of friction between the parties, because It's not identical, it should be similar. So my meaning of similar and your meaning of similar could be completely different. Okay. Character means that it has the qualities or features of which one type of specific work is distinguished from another. So they have the same type of character. So for example, blasting in rock and excavating soft soil, it's not the same type of actual character. Okay? And then you also got to consider the conditions. The physical situation of the work is executed under and affected by similar weather patterns, under similar methods of work, and it can also be under similar working periods. So, for example, if you are going to be working on a refinery project in Qatar in the heart of summer, and you're working in a refinery in South Africa in Secunda in the heart of winter, the conditions are completely different. So, it's very important that where there is a requirement to determine or to evaluate or to determine a rate or price utilizing the concept of similar character and similar conditions, that is actually spelled out better and explained or expressed better in the contract, even in the contract under the specifications, so that both parties can understand what it means, and that there is an agreement upfront in terms of what it actually means. Look at mediations. So, in order to discharge a 3.5 determinations for omitted work, that omitted work must sit either fully, partially under a variation. Okay? And you also got to test. There's a couple of tests you got to do. And the first test is that if that work that was omitted that work is covered by sum of part of the exceeding contract amount, okay? That sum, and it doesn't form part of the contract later. And also, if the contract would have incurred or has incurred a specific cost in respect thereof, and that cost is not included in the valuation of any substituted work. When you say substitute work, it means it could be of similar character or condition. Then the contractor can then seek a 3.5 determination in terms of that. Okay. For example, let's for argument's sake say that you're going to remove a tower, and you bring your crane to site. You've got to bring your crane to site early because the crane is a special crane, and if you don't bring it to site, you're going to lose it. Now, the crane, before it starts the work gets terminated with a variation order. Now, you've incurred as a contractor, you've incurred the actual cost of the crane. And if there's no, and because it's a unique type crane, there's nothing similar in there, you can then request your cost you incurred or will incur can be determined and be paid under the actual contract price. So it's under the this is a very, I try to steer clear of this. I try to look at those conditions under A, B, and C in terms of calculating it, because this can be also, as with the previous discussion, it can be it all turns on interpretation. If I look at the 1999 versus 2017 edition, under subclause 12, clause 12, measurement valuation, there's been a reword change in 2017, and that sits under the valuation of the works. Instead of evaluation, we now have a valuation. The difference there is that a valuation can only be done by a evaluator. And that poses a question that the engineer may not be a evaluator. He may have to delegate that to a evaluator, a competent evaluator, and that's the only difference. And I'll take you through the actual word differences we have in terms of subclause 12.1. So in the 1999 Red Book, the engineer must give the contractor reasonable notice to say, I'm going to measure part of the works, or specific part of the works. In 2017, you must give the contractor a notice within 7 days of the work you measured, and that notice must express which part of the work is going to measure, the date is going to measure the works, and the place or site where the measurement will actually take place. And then also where the engineer is got to reconstruct records and they need to inspect it. Same principle apply under the 1999 Red Book. You've got to give notice. 2007 Red Book. The notice has got to be in 7 days. It's got to specify exactly those 3 items. And the subclause 12.2, there's no substantive changes. There's just little words here and there, but there's nothing substantive as how you got to give notice. That is not at play in terms of the 2017 version. And then on the valuation of works, under 1999, there was no provision for profit. However, in 2017, is now introduction of an alternative method of deriving the appropriate rate of price. And that is that can be a reasonable cost of executing the actual work. Again, what is reasonable? Reasonable can be very broad, and that is also very, very the test for reasonableness in the court of law is that it's what a reasonable person is, not the most competent or least competent. It's someone sitting between the most competent and least competent evaluator that will establish that. And that is a very, very broad gap. Then also it allows for 5% for profit if none is stated in the contract data. So in 1999, this is not at play. And then also what it introduces a time limit in respect of agreeing or determining the actual rate. And then the engineer is obliged to assess a provisional rate or price with the purpose of IPC if he has not, if an appropriate rate or price is not agreed or determined within the actual time time limit. So those are the differences. The 2017 is a lot more, I believe, contractor friendly because it now stipulates the capital deposit. The notice must be clear, must be within 7 days, must say the date, where and what we're going to inspect. And then omissions, there's no substantive changes made between the 1999 and 2017 editions of the Red Book. There's been no substantive changes to the wording and the conditions therein. My time is running out, so that is it. Thank you for your time. I'll hand it back to you, Jen. Thank you.
Okay, thank you, Mark. Will the changes to the contract amount be accepted, contract sum inclusive of the budgetary allowances or provisional sums?
So your accepted contract amount would include any items that's only put in place provisioning. Your contract price will be the actual. So, for example, let's for argument's sake, say you have a budget amount of in your accepted contract amount of $50,000 US. But when you execute the work, it actually comes to $100,000 US, and that becomes the actual contract price. Okay, so your contract price is basically your as-built contract amount as it gets amended through omissions or variations, and that moves away from the accepted contract.
Okay, all right, thank you. And I think we've got one more question that I think could be a quick answer. This goes back to the reduced labor hours. And they asked, I imagine this assumes labor are paid daily and not hourly, and there is no improvement in productivity as a result of working reduced hours.
Okay, so you can convert a hourly rate to a day. So, for example, if a specific person earns 10 Rand per hour per day, it works 8-hour day, it's 80 Rand for the actual day. So you can interchange it, and you can bring it up from a day to a month to an hour. Sorry, from an hour to a day to a week to a month. You can do that, and then also productivity issues. As I said previously, you got to separate the actual the events. A productivity issue is one event. A reduction in working hours is the second event. So you would have to do your calculation on each of those events in order to establish what the impact thereof was. Thank you.
Okay, and I think that is us out of time. So Joel and Deep, you haven't typed your questions. If you email them to me, I will see that Mark gets them. Gregory and Goran, I will be able to print out your questions, or you can ask them in the ICCP Academy if you have registered for that one. And with that, Mark and I both have to go because we are going to the follow-up ICCP Academy session that is immediately following this. And if anyone who is watching this is an ICCP member and wants to attend that academy but did not register for it separately, please go very quickly, check your emails and register for that quickly because it is a separate session. Okay, I want to thank everyone for attending today, and thank you so much, Mark, for this very informative session. All right,
Thank you.
Goodbye, everyone.
Bye-bye.